For more on this, we go live to Los Angeles. James Barth, Senior Finance Fellow at the Milken Institute, joins us. Welcome to Biz Asia America. I want to first start by asking you, why do we need the Volcker Rule?
I actually don't believe we do need the Volcker Rule. I think the Volcker Rule is based upon a false assumption, and that is that proprietary trading by banks, that is proprietary trading in securities and derivatives by banks, caused the financial crisis here in the United States a few years ago. I think that's a false assumption. And those that believe the rule adopted today will prevent a future banking in the United States will be sadly mistaken.
People forget that when we repealed Glass-Steagall in 1999, President Clinton, a Democrat, was in office. The irony, many years later, when we experienced a financial crisis, there was a lot of blame to go around. Nonetheless, the fact that Wall Street wants to make bets or invest their money, depending on how you want to word it, what's wrong with that?
There's nothing wrong, and the regulatory authorities are supposed to supervise the banks and regulate them in such a way that they don't make bets that are excessively risky. But as I pointed out, there's no evidence whatsoever that proprietary trading by banks caused the recent financial crisis in the United States. That's a mistaken belief on the part of many individuals.
You say it's a mistake. However, the perception is that a lot of people believe because the banks risk-taking, I should say, that helped cause the financial crisis. Perhaps cause is the wrong word, but maybe exacerbate the crisis on its own. Did it play a role at all if it's not the cause?
It may have played a role, but a relatively minor role. What happened in the United States basically started in the housing sector. We had a housing price boom and a bust, and that spread throughout the financial system, adversely affected banks. It wasn't proprietary trading by banks that set off the crisis here in the United States. And indeed, the $6 billion loss that was mentioned earlier in your broadcast by J.P. Morgan Chase basically didn't in any way threaten the solvency of J.P. Morgan Chase. It's a big number, inappropriate number, but didn't threaten the solvency of J.P. Morgan Chase.
As you look at the banking system as it is today, a lot has changed over the past 5 years. There are new rules. There are new internal regulation at banks when it comes to documentation on home loans and housing loans and how they deal with customers' money, both institutional and private money. What do the banks of the future over the next 5 years, when these rules ultimately are likely to be in effect, is it going to affect the average person like me and everybody else sitting in this room?
I think banks today are in much better shape than obviously a few years ago. And indeed, a lot of the regulations have been implemented, I think will go towards making for a safer banking system. But the Volcker Rule may actually result in risk being shifted from the banking sector to firms in the so-called shadow banking sector that are less regulated. So we may not be reducing risk overall in our financial systems. We may be shifting it from the banking sector to other less regulated parts of the financial sector. That's what I worry about and what we have to be in guard to be sure it doesn't really happen. The regulatory authorities have to do a much better job of detecting risk earlier. And then, as was pointed out earlier in your broadcast, we won't know until sometime after July of 2015, when the Volcker Rule takes effect, how it's going to be implemented and whether or not it's going to be adequately enforced. That's a key issue.
I want to ask you about what some of the critics are saying in respect to the banking system and the risk that they take. After the crisis, a lot of people blame the banks for not forcing people to take loans, but I guess pushing people to take loans and perhaps some misleading documents. Some call it falsification, some call it perhaps just aggressive marketing. But have banks changed their practices today?
I think we now know banks have been hit with a lot of heavy penalties for some of their past behavior. So I think banks indeed are building up their capital, subject to higher capital requirements. They're required now to be more careful and prudent when they make, for example, real estate loans. So I think banks are much safer now. The point is, you can't take all risk out of banking or you take all the profits out of banking. One has to realize that fact.
Yeah, risk and reward. James
Exactly.
Barth, thank you very much, Senior Finance Fellow at the Milken Institute. Thank you for your thoughts.